Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we are going to be analyzing United Rental stock. I had several requests for this one down in the comments sections of my other videos, and so we're going to take a look at it today. The ticker is URI. If you have a request you'd like me to take a look at on the channel, just put it down in the comment section. If it's a stock that's in the S&P 500, like United Rentals, I post those in YouTube for free. And the rest I post over on Patreon. And at the $5 tier a month level, you can get those non-S&P 500 requests there. And then I also have a $25 tier where I put out a weekly pick each week, which just started a couple weeks ago. So, and there is a free tier as well, where all the same videos that I post on YouTube, along with a few extras every now and then, get posted on the free tier Patreon. So it's a good place to follow me, so you don't have to rely on the YouTube algorithm to get my videos in front of you. And I think there's over 100 probably analysis from the past year since I relaunched the channel last October. So lots of analysis to look through. I prefer to kind of teach through analyzing individual stocks, and then through the perspective of my own strategies. So, because I don't think too many other people take that approach. There's a lot more macro, a lot more theme-based kind of investment channels, or channels that are focused on executing other strategies that they haven't really developed themselves. So I think that makes this channel a little bit unique, even though I do plan to do some more macro and theme stuff at some point in the future. As always, this is not individual investing advice. This is just how I analyze stocks. Okay, so United Rentals. The first thing I like to do on the fast graph here is look at the historical earnings pattern, which is this dark green shaded area, to see what sort of cyclicality, or see if there's any patterns that I pick up on. My view is that history is the best guide for the future, and it can tell us a lot about what type of business it is. And the thing that usually tells us the most about it is the earnings history. Now, sometimes there will be issues that come up where the earnings history isn't necessarily super reliable, but I always like to start there. And we can see that if I shrink this time frame down, so we can see a little better, we have a period in 2004 where earnings were negative, completely negative, where they lost money. And then we have another one in 2009 where they were completely negative and lost money. So, but the good news is they recovered quite quickly from both of those downturns. The Great Recession took about 3 years from the peak here to a better peak. And I don't know where they peaked at before. The fast graph only goes back 20 years, but I did look on Y charts, and it looks like a similar pattern actually for this post-2000 decline, and relatively quick recovery actually. So that lets me know that this is a cyclical business. Now we can also, actually, let me go back to where I was. In addition to the earnings, which is what I like to start with, you can also look at to see what the stock price did. So we know earnings were very cyclical, but did the market care about it? And we can see here that I didn't even try to pick the very top and very bottom. We have like a 90% decline in the stock price. So yes, the market cares about these earnings fluctuations. At least historically they have. We've also had drawdowns during these other industrial drawdowns. So this was like the industrial recession when the fracking bust kind of happened. They lost over 60, the stock price went down over 60%, even though adjusted earnings kept growing. But if we look at basic earnings, we do see a drawdown in 2012. We see a pretty much complete flattening during this period after some growth. So basic earnings don't look quite as good as the adjusted earnings, especially during the Great Recession, which shows 3 years of negative earnings growth. So it looks a little worse from that perspective. And then the recovery looks a little bit longer, but that's still pretty good. I usually use the adjusted earnings, but sometimes when they're suspiciously smoothed out, like these guys are, especially when it's in conjunction with a low PE and a stock price decline, like we see here, like a real kind of disconnect, then it's worth looking at basic earnings to see. So, and we can see that basic earnings didn't look nearly as, and probably this was a tax, well, I don't think taxes got cut until 2018. So I'm not sure what this big bump was. I could go back and look. It's possible there could have been some M&A or something. I'm not sure. But we did have like 1, 2, 3 years where the basic earnings basically slowly went down and the stock price followed. So we can see if earnings aren't growing, the market likes to send this stock down using the basic earnings. And that can help explain some of this disconnect with these crazy low PE ratios. It doesn't look like they have like a ton of debt, but the credit rating is only BB+. So there could be some other obligations here. It says long-term debt is 56%. So I don't know exactly how the accounting works. I mean, this is a rental, so these guys rent like construction equipment and things like that. There could be accounting issues with that on, I'm not an accountant, but you think if you have like very expensive, like bigger equipment, there's probably depreciation that goes in there. And so they could be accounting for things in different ways. So whenever you see something that just looks kind of suspicious, like a 7 PE, right, on a stock that's growing earnings 20% or something like that, it's worth kind of saying, okay, well, why is that? So that's what I'm kind of doing, just poking around. And so with the 56% long-term debt to capital, and then credit rating that's only BB+, that's a sign that lenders know that there's a risks there that aren't reflected probably in that PE alone from the adjusted earnings. So I would not get to it. And then we know this is a cyclical business. Lenders know this is a cyclical business too. That means it's higher risk. If you have 3 years where your GAAP earnings can be completely negative, that creates more risk if you're loaning the company money, right? So I don't usually look at credit ratings unless it's like good credit ratings don't really mean too much to me. But if the credit rating's lower than you might expect, then I do pay attention sometimes because those guys are doing more deep work. I try to look at the big picture and investigate these little things and put the pieces of puzzle together quickly because I analyze a lot of stocks to give me a overview of kind of what might be going on rather quickly without spending a week or whatever just doing nothing but reading about United Rentals. So I can get the big picture there. I can tell there's risks that aren't reflected in my normal metrics, right? But I know it's deeply cyclical, so that explains a lot too. So when you go and look today at the 18 PE, that might look reasonable, but it's not reasonable if earnings fall 90%. All right. So that's the important thing to keep in mind. And really, we just need to go back 2 years to see that the PE was 9, right? So other than that, it's a good. Doesn't mean there's anything like wrong with the business. It just means it has cyclicality. It's connected to kind of the industrial economy. When I look at the stock price and the earnings, they coincide with that. And when people are doing like construction and building and expanding, I would also think this is probably normally correlated to interest rates to some degree, but I'm not totally sure about the dynamics of that. If interest rates are high and these guys have the equipment already and maybe they paid a lower interest rate or funded it a different way, it could be an incentive to rent the equipment rather if you're a business that needs the equipment rather than going and buying it yourself. So there could definitely be some like dynamic, and I don't know enough about the specific uses of all their different businesses to know that. But it's just, these are the things that I think about when I'm thinking about it. But the bottom line is the stock price can fall a lot, and it's at an all-time high. So what I want to know is how far has this stock price fallen, because we know we can't really trust the earnings too much because they can fluctuate a lot. So what we can do is go back and say, okay, how has the market treated this stock in the past during down cycles? And that will tell us, that'll kind of cut through everything and get right to the bottom line. So that's what I want to do here. So I actually was not tracking United Rentals. I just put it in the spreadsheet for this video. I was kind of surprised. But I ran the numbers on it. So we're going to have them now. I went back and looked at historical drawdowns. I use Y charts for this. If you want to do it manually, you can, but it's much quicker if you can get rid of this extra percentage here. All right, so the 2021 drawdown, the stock went down about 87% peak to trough. 2008, about 91%. So these are really big drawdowns, okay? And then 2020, which was just this is actually was from the peak in 2018, which tons of industrial stocks fell during this time. Also, the economy started to roll over, and at the end of 2018, the Fed lowered interest rates quite quickly to try to stave that off, and they were successful at doing that at the end of 2018. But so their decline in 2020 wasn't just like a quick January to March type of decline. It started in 2018 with the rest of the industrial stocks, and then it kind of double dipped when the kind of normal crash came on top of that. So we have, so if it's just if you take that, and then there's been a couple mid-cycle drawdowns too, like the 2015 one that I showed you that kind of bottomed around the beginning of 2016. Those all tend to be about a little over 60% drawdowns. And then when you get like a real recession, you're looking more 80-85% drawdown. So that's where I come up with these two estimates. A mid-cycle drawdown, or a mild, or just an industry drawdown that's associated just in like the industrial part of the economy. You might see the stock fall 60%. But a recession might see the stock draw down like more than 80 or 90%. So I use 60 and 80 as my reference points here. And then the stock recently peaked at $826.24 a share. So if I was thinking about when am I going to buy this stock, there's no way I would ever buy it unless it was at least 60% off its highs. Because even the mild drawdowns, historically, it's fallen a little bit more than 60%. And you could go back to like in the past 25 years, we had two really deep drawdowns, and we had at least two of these mid-cycle drawdowns, maybe three. So that would be my first starting point. And given that we've had like some inflation, underlying inflation, things like that, I would be tempted to come in there depending on what else was available in the market. And then if we ended up getting like a bad recession, you could consider coming in when it's like 80% down. The risk reward would be pretty good then. So when we do the calculations on that, right now $330 a share would be the buy price, it's near its peak, so it's like 59% lower than where it trades right now. But if we just go back to the fast graph, and so sometimes I tell people these numbers and they think I'm totally crazy. And I'm not predicting that that's the price that it's going to end up at. What I'm saying is if it falls that far, that's when a person could think about buying it. Now, if I owned this stock, would I take profits now? Probably, yeah. I probably would have done already, but that's kind of another situation. And again, I wouldn't necessarily be calling a top. What I would be saying is we're at a peak, and there's no reference point to really know what the market's going to pay in the future. So it's really just an unknown thing, and you're at a peak, at a new high anyway. It might not end up being a peak. It could be a higher peak, right, ultimately. But you're far, far away from like a buy. You could easily lose 60% from here. And there won't probably be any warning, right? So if we just go back, so my buy price is like 330, I think, on the 60% drawdown. You only have to go back to mid 2023 to get that number. Like May 2023, the stock was down at 325. So it's not even that long ago. It's like a little over a year ago, year and a half. So yeah, that sounds kind of crazy, and I actually think that's a pretty aggressive place to buy, like a pretty optimistic one, but not an unreasonable one. Let's see the drawdown in. I didn't check this one before. Yeah, so it fell 40% in 2022. So, and that was without a recession. The peak PE that it was trading off of at that time, what peak PEs can be interesting to look at even with a cyclical. You get to see what they were valued at as they were peaking before the earnings fall, right? So you can kind of get a read sometimes. So that peak PE before it fell 40% was 18.36, and right now we're at 1872. We're at a similar peak as we were back in the end of 2021 before it fell 40% in 6 months. Yep. So yeah, I think there's a lot of downside risk here, but I don't know the timing of any of that. The stock could go on to make higher highs. Could go back and look at some of these other peaks, I guess, and see. Here's a good one. Yeah, so the 2014 one, peak of the fracking boom, 18.91 PE. Again, same about where we are now. 2018 was a little slightly lower at about almost 17 PE. But we're kind of in the same ballpark. And you can see the last time the stock was trading kind of like this preceded mid-cycle downturns. They didn't turn into like full-blown recessions. So, it'd be more like a 60% drawdown than an 80 or 90% drawdown. But it's poised, it's priced like it usually prices near a peak. So hopefully that helped everybody. Thanks for asking for this one. I hadn't really looked at it closely for quite a while. But I'm now watching it, so if it falls 60%, I'll let you know if I buy it. Hit the subscribe button, hit the like button if you found this useful, and I'll see everybody later. Bye.